For landlords, by landlords. The Rent Perfect Podcast with David Pickron.
Well, hello and welcome to another episode of the Rent Perfect Podcast. We're going to talk finance today. We're going to talk something that sometimes is difficult to do. I have Aaron Chapman with me today. Aaron, how you doing?
Doing very, very, very well, Dave. Thanks for bringing me on.
Aaron, you know, we bring people on this podcast and we try to let people know kind of what's going on today. And so we like them to like us and subscribe and, you know, continue to listen to things that we have to offer, because today is going to be amazing. And we're going to update everybody on kind of where we're at with investor finance, which is often a difficult thing to deal with, right?
Very.
I mean,
frustrating at the least.
Yes, because things have changed and a lot of regulation, and so we just kind of want to go over where are we at nowadays, and how hard is that process? Should we go to banks? Should we go to somebody like you? You know, and things to help us out. So we're glad that you could join us today. Just so you know, Aaron and I go back a very long time. Been friends for a long time.
And well over a couple decades.
Yeah, and just tell us a little bit about your history, your company, what you guys do, so we just get an idea of your background and who's giving us all this good information.
That background can get pretty deep. So I'll try and condense it real quick, because a lot of people, if you can see the podcast, you're probably thinking, okay, Dave's talking to somebody who's supposed to help on the finance side, right? And everybody has a picture in their mind of what a real estate finance guy looks like. So if you're looking at this, and if you're listening right now, you're going to have to eventually just jump on there and take a look at what others are seeing.
Well, and if you've seen Duck Dynasty, then maybe
those some bitches copied me, because I had it before they did. He was still in Harvard. He was still at school when he did that. I think they had frosted tips on the hair. So I grew up doing, my high school years was cattle ranching. Then, graduated halfway through my senior year, not because I was good in school. I figured out how to pick a lock, and we won't go any deeper than that. And then graduated, went to Wyoming, worked in the oil fields, worked for a welding company, and then ran heavy equipment, drove truck. I did all these things, and I found an opportunity to work in the mines in northern New Mexico. Greatest job ever. Still, I believe that. You'll go several hundred feet underground. You're playing with explosives and heavy equipment. There is no better life for a man.
Okay.
So that's what I was doing. They shut down that project. Had to come back to Arizona. I was looking for a job. Looking. Couldn't find anything to save my life. And I was getting turned down for everything I applied for because I was overqualified. Overqualified, I didn't understand the word at 23 years old. Didn't make a lot of sense. But I found myself in a situation where I needed to find anything that would at least put some money in the account. So my wife gave me a coupon for free diapers as I was walking out the door to go apply at a landscape yard to haul landscape rock for $10 an hour. Now, this is over on I-10, just south of the 60, right there on the, if you're heading south on the left, you'll know where it is. I go in there, again, overqualified. I leave there wiping tears so people couldn't see how upset I was. Get in my truck. I'm driving to the grocery store, and my gas light comes on my truck. Now, I had not driven this thing ever long enough on a gas light to know how far I could go, so I found the first store that had a gas station, pulled up, had my debit card, said a quick prayer, ran it, got a decline, overdrawn account. Rifled through my truck looking for at least a lost dollar, I hoped. Found a couple coins, locked the doors, walked that parking lot for a couple of hours to find enough change to get 2 gallons of gas. Now, this is 1997, right? People carried change. Right. Gas was 87 cents a gallon, 89 cents. We could get away with buying gas with an afternoon, well, not even an afternoon, to walk in a parking lot. Got my gas, went inside, found the diapers. And I don't know if you've ever been through a day like this, but standing in line with one item, and to pay for that, you've got a coupon. It doesn't feel real good, right? So when I'm leaving this place, I got my head down, I'm hauling ass, I'm trying to not look at people's faces, and somebody recognized me. He called me out. I went and approached him. We talked, and his name was Keith. I glazed over things. I didn't tell him the depth of what I was dealing with at that time. But he said, we should go to dinner. I'm like, dude, I'll just be honest, man, I can't afford dinner right now. He goes, no, I got a gift certificate to Red Lobster. Let's go. So at Alma School in the 60 there, we went to Red Lobster. And that's where Keith told me about the mortgage industry, December of 1997. So I cut a foot off of my hair, shaved. My mom bought me some business-like clothes, and I started as a telemarketer there in December of 1997 at a little broker shop on Alma School in Southern. Now, that's where it started. It was doing refinance for people to try and understand this. And it grew to the point where I discovered the real estate investor coming into Arizona. We had the crash. Right. You and I experienced some other things together during that 2008 crash that was a very life-defining moment. But then they started coming back after that in 2012. Actually, it was right around 2010. People started coming into Arizona to buy the low-cost real estate. Still had high rents. Now, what's really interesting about this whole thing, real estate plummeted to extremely low points, but the rents did not.
Right.
And why is that? A lot of people don't quite wrap their head around what happened is because people couldn't keep their home. They couldn't get financing on a home. They now entered a rental pool that kept growing. The demand increased. So when housing drops and housing has problems to that effect, people still need to live somewhere.
Right.
We see the inverse effect in rents. So that became a very great place for people to get long-term cash flow, and to invest their money was into investment real estate at low prices with great rents. Now, interest rates are then starting to come down a little bit because of because of what the Fed did in 2008,
right,
which is quantitative easing. Now, what people need to understand is what drives interest rates. It's not the Fed. It's not the federal fund rate. It's not the 10-year. Everybody wants to follow the 10-year. It's an actual security that collects money to lend out to the loans. It's a long-term bond. That's why they look at the 10-year, because the 10-year is a long-term bond, just to see the flow of money in the market. Is it going towards long-term securities like bonds, or is it going to equities such as stocks, or is it going into commodities like precious metals, or is it going into something else? So it's just a gauge to see what's happening. Now, if the economy is doing strong, people go into equities. If the economy might be getting weaker, they're going to go into long-term instruments so they can predict what their return is going to be. So when the Fed says we're going to do quantitative easing, because nobody was putting money into the mortgage-backed securities market at that time because of all the fragmented markets and the fact that they lied to us of what your money was going into. Everybody lost trillions of dollars in the markets, or at least hundreds of billions. So the Fed started dumping that in. The second they announced it, November 25th of 2008, there's a massive injection of capital. January 1st, 2009 is when they started putting money in. So $1.25 trillion from January 1, 2009 to the end of March 2010. All that money means there's a supply, right? The bigger the supply, the lower the cost. Economics 101. If there's a massive amount of milk in a grocery store and they got 3 tractor trailers that say got milk on the side, milk is very cheap. But if you have 4 gallons in the store and the store manager is standing on the customer service desk auctioning it off, milk is very expensive. It's the same concept. So as the Fed's dumping money in, rates are going down, right? Well, then you get to October of 2021, and the Fed announces definitively quantitative tightening. So what they're doing is the money they've injected, $8.9 trillion. Think about that amount, guys. $8.9 trillion dumped into the markets. They were reinvesting their earnings on that money and keep growing and keeping the pool heavy. They stopped reinvesting on that date, and then everything plummeted in the market. The market dropped, therefore the rate started to go up. Supply started to shrink. Cost went up. So everybody asks me now, when are rates going back down? Because everybody says the market's cyclical. So 10 years ago or 5 years ago or whatever rate we saw then, we should see that again. The only way that we'll see that is if the Fed does quantitative easing again, and they're not going to. Look at what happened to us with inflation. So I went back and I got these charts out, and everybody's talking about the channels that these markets trade in. And I was like, I'm going to look at these charts and really understand what was the market before the Fed had this big influence. I drew it all the way back to that date of November 25th, I think it was, 2008. And what the chart price point was on that day. And I just drew a line straight across. And if I had the charts here, I'd show you to show that's going to be our ceiling. That's the highest that any of this will go, that any trader will take that security to, therefore the lowest interest rate that we will see. We come crawling back to that point. In October this last year, October 2023, we rocketed up to that point when they started giving us real job data, not the fictional job data we're getting to try and make our administrator look like they were doing something, which they're not. And it went rocketing up, and it hit right on that point I said. It bounced off it. Tried it again, and it's been coming off of it ever since. We have seen our lowest interest rates that I believe that we will see without external influence. So what does that mean to people? And we're like, well, damn, we lost our window. That's the biggest complaint that I get from most people. I guess I missed out. You didn't miss out on anything. If you look at what's happening in single families today, 44% of the single families purchased last year, 2023, was done by hedge funds. It is said that by 2030, the hedge funds will control up to 60% of the available single family housing by 2030. So what does that mean? That means we are going very heavily towards a subscription-based economy. Your housing will be the same as any other subscription. You're going to pay somebody else to provide something to you. Now, anybody listening to us right now has the choice that they get to make. They're going to be the subscriber going forward or offer the subscription.
Right.
And if you're going to buy investment housing and offer the subscription, just know that the market will be driven by external forces, which is the hedge funds trying to dictate what that market is. It's all about supply. There's not enough supply presently. We're over 1 million units short in the United States for what we need, and we have 12, maybe 20 million we're going to anticipate by the end of 2024 that are going to be in our country that also will need housing.
Yeah. Yikes.
It's scary. It's extremely scary. And I think that scares me the most is not what's going to happen to me, not what's going to happen to my kids, because, we as a family trust, I started a family trust to buy houses, and then our family, we all rent from the trust and pay the trust, so we never not have a place to live. But what's my great grandkids going to do? Mm-hmm. If I don't do this now, they don't have a shot.
No. And how long is that wealth going to last through generation? I mean, it's going to take you pumping a lot of money to your kids for it to make it through your kids' lifetime and then into your grandkids, and hope that they don't squander it.
100%. So how we prevent that? I'm trying to prevent it. I don't know. The only way I'm going to know if it's prevented, I'm going to have to be looking down on them about 100 years from now and say, did they do it or did they not?
Right.
Because we all know the Rockefeller name, right? Rockefeller meant nothing before a guy by the name of John D. Rockefeller, right? It was just another name. But then you get John D. Rockefeller, and it changed everything for the history of it. We also heard of Cornelius Vanderbilt, right? That meant something up until a certain point. Now what we remember is Vanderbilt is the guy who didn't do it right, and 3 generations later, there's not a single millionaire Vanderbilt left. There's just not.
Right.
So they destroyed all that wealth, and he was the wealthiest man on the planet at one point. So how does a person become the Rockefeller for their family? We've got to do something. So what I've done is I've investigated what they call the infinite banking strategy, buying a whole life policy that I have cash value available to me in the form of a credit line. I take that money, I buy investment properties. I take the cash flow plus a certain amount of my income to pay back that credit line to keep it going. And then when something happens to me, not only do I have my capital available to me to invest, but now I have a death benefit that kicks into my to my heirs. And it supercharges the assets. Right? And everybody in the family has to have one. So all the immediate family members, we as a trust hold those life insurance policies on them.
Right.
And then as they leave and start their own family, they are required, by the way the trust is written, to get them have a policy and their spouse have a policy and continue the same process and perpetually continue that. And we have meetings about what we have, and we talk about that once a month about the assets and all those things. Now, the reason we do that is to hopefully perpetuate this. Then also, let's just say in the short term, my daughter and my son-in-law, something happens to him, there's a death benefit. She doesn't have to come live with me again. Right. My dad told me that when you have kids, they never leave, they come back and bring more. Well, I'm trying to prevent that too.
Well, you have covered probably 5 topics that we could do podcasts over. So you give us a high level here. Let's come down and let's talk about where are we today. If I have a property I'm looking at, how hard is it to get financing, to get a mortgage broker to help you? How thick does the file have to be? In other words, how much information do I got to have to come up with? And how hard is access to money right now in your world?
Access to money is actually very, very simple if you know who to work with. Okay. You had said at the very, very beginning, do you go to your bank? Do you go to a mortgage broker? Who do you talk to? And of course, I'm going to say you got to talk to me.
Right.
I mean, it'd be stupid for me to do otherwise. No, you go down to your local bank and talk to the fool behind the counter. Right. And if he's got a really nice polo, that's the guy you talk to. Nice polo, by the way. So it's a very, very intricate side of the industry. Think about 2008. We talked about that crash. Nobody wanted to do loans, and the loans that they were doing wanted to stay focused on the owner-occupant period. Do you remember the movie The Big Short?
I do.
Okay. Do you recall the person portrayed as the real estate investor in there, the person with multiple houses in that movie?
I do not. Tell us about it.
It was the stripper.
I do now remember that.
Now you remember that, right? So I find it interesting that the person that they portrayed as the person with multiple houses was a stripper. Right? Because they didn't think a lot of the person who did single family acquisitions in bulk, right? Because those people pre-2008, not you pre-2008, not me pre-2008, but a lot of people pre-2008 were just buying because you could sell them in a month for a lot more money. Or
and they did stated income.
Yeah, stated income, no money down. You can pull cash out in a month, and that's what she did. I just kept pulling cash out, right? I can't do that anymore. What are you talking about?
Right.
That's how we were viewed because that's what a lot of people were doing. So money was not prevalent. So I had to fight through a lot of hell to convince the Fannies and the Freddies and all their banking entities out there that this is a viable product. Up until 2016, it was a fight. Until 2016, Fannie and Freddie both, representatives came into the office of the company I'm still with, and they wanted to look at every investment property loan we did. So then I got called in for this audit conversation. I'm talking with everybody about to give me a rundown of what we're dealing with. On the way to the airport, I'm being driven by the president of the company to the airport and asked him, Steve, I got a question. We do a lot of first-time home buyer loans as a company, right? He goes, yes, we do. How many times do you get audited for those? He goes, come to think of it, never.
Right.
Okay. The value of a portfolio for a lender is based upon the percentage of delinquencies versus outstanding loans, correct? He goes, yes, and defaults and that kind of stuff. I said, okay, so what percentage do you think first year delinquencies will you have in a first-time home buyer? He goes, it's easy 10+% of our portfolio.
In an owner-occupied.
Yes. Especially the first-time home buyers. I said, so what about, have you investigated what it is for mine, the real estate investor? He goes, no, we haven't actually looked at that. They analyzed over 1,300 of my personal loans that I've written at that time because I'd only been there a year, actually about a year and a half. When they're looking at that, what percentage do they think they found of delinquencies in my files?
5%.
They found 2 files, not percent.
2 files out of
2 files
1,300.
over 1,300. And it turns out one of them is because the bank statement was being sent to the wrong place, or the mortgage statement. So they had actual one true delinquency. But what that did is it made Fannie and Freddie look, it's like, wait a minute, because we pointed that out. Why are you auditing and busting my chops? Let's look at this. And like, wait a minute, this is actually a good business. And they decide this is a very good business. So I have been able to, because of the difficulties I went through, to be able to carve out and show year after year a very, very solid performance with my clients because of how we go about things. Now, I'm not saying we have a special row cut for us. We don't.
Right.
They're not making it any easier for us. But what they did was shared with me all the little things that they look for so we could create a better product for them.
Okay.
And in that, I was able to create a team around it. So when we're talking about getting financing from the banking industry as a whole, the industry itself is still very, very apprehensive on the real estate investor. I've been focusing on investors since 2003 and doing my dangest to find out every little idiosyncrasy that makes that real estate investment loan a good, viable product for the lender and then the investor themselves.
Okay.
So yes, it's going to be difficult. It's a lot of paperwork. You have to qualify. It's all the same things. Dodd-Frank Act was not kind to us. We are the most heavily regulated industry on the planet. And because of all that, you now get to deal with a lot of paperwork. So here's the difference. Anybody who's done financing, you've probably heard the word underwriter before, right?
Yes.
Usually talked about the last week of the deal. And we've done deals together. We know because you have a lot of paperwork. And if you guys want to talk about paperwork, this guy is
my files are thick.
Yeah. We just underwrite yours by the pound.
Right.
You know, we don't do that for everybody else. But usually underwriter has to ask for a lot of stuff at the tail end. Your simplest deal is going to have that. We try and limit that by just beating you up with paperwork out of the gate. And you've experienced that before. Get a ton of paperwork up front to make sure that it works, and then we get to the closing. But if you're going to try and search mortgage brokers, mortgage bankers, regular banks, you are literally taking your sanity giving your sanity in somebody else's hands. They don't understand it to the extent that a person needs them to understand it to be successful as a real estate investor using conventional capital today.
Right. So I will admit, Aaron, when you and I have done a deal in the past, it gets frustrating for me because I almost feel like everybody sees my history. Everybody knows what I have, but you have to just protect yourself and just get a letter, get a whatever. So when we do a deal, you're like, Dave, gear up, get strong here. But what I love about dealing with you on deals is you keep all that documentation, so I don't have to always re-give you everything, right? I just have to keep updating the files. I don't have last year's taxes. I don't have... And you guys kind of consolidate all of that stuff. Now, you'll still have a different underwriter that asks for a few different things. But I do love working with you in the fact that you make that painful process
slightly less painful.
Yeah, slightly less painful. But so nowadays, I have somebody who, say, bought their very first rental home. And they come to you and say, Aaron, listen, I'm looking at a place. I've made an offer on it. I need to close on it in 45 days. Tell me what they go through. Give me just a general. I know everybody's different and everybody's history is different, but tell me what you're going to ask for right out of the gates.
Well, let me explain kind of how we try and set that up. And if it's perfect, it goes this way. So it'd be just going to my website, filling out the data, aaronchapman.com, click on apply now, fill out your information, just do a general brain dump from your head to your keyboard. My team will download it, review it. They'll send you next steps, which is
okay. Let me stop you. Let me stop you real quick. Okay. I'm going to stop you. But when our listeners are listening, they're not all from Arizona. So what states can they go to aaronchapman.com and do this?
I'm licensed in 30 states. I don't remember those. What's interesting, I do maybe 5 deals a year in Arizona, and most of the time it's yours. So. Okay. So I don't do a lot. I live here. I've done a ton of business here, but most of my business is in the South and the Midwest.
So I just want to make sure we have a nationwide audience. This is not just Arizona only. This 100%. Is a nationwide audience. Okay. Sorry, go ahead.
So then that team member who downloads that, they're going to review the data that you provided and then give you a list of documents to back things up. So you say that I have an income that's a W-2 income with XYZ employer. We want 2 pay stubs from XYZ employer. You have an account at a specific bank. We want 2 statements from that particular bank. We need 2 years W-2s and bank and tax returns. And we'll get the whole list. Then we send you the instructions on how to upload it directly to your file, so it's not lost in email. You're not going to get frustrated because you can't, because it's too large to send. Then at that point, an underwriter themselves takes a look at that file and they review it, and they give me the recommendation for a qualified buyer, and I sign the letter and send it to you to go buy investment properties. Once that property is found, a contract comes in. We review the contract. We send another letter to or an email to the interested parties, both realtors, and say, confirm these 8 items for me. Then I get a phone call from that realtor, tells me, we don't know our business because you're asking stuff that's on the contract. We're like, do you know how many times there is an addendum or a change in the contract by time I get it that we're not aware of that holds up closing by a week, and you're frustrated with me later that I didn't get the addendum that you were supposed to give me.
Right.
So this is preventing any of those problems. Can you confirm that some of these things are
So
accurate?
you include the realtors.
We include everybody. We look for accuracy right out of the gate. Then we order the title. We order your insurance. And the biggest thing that we wait the longest for is people's insurance, because they're still wondering what they should get, and it takes forever to decide what insurance agent. We order an appraisal. All that stuff comes in. It's analyzed. It's reviewed. It's re-verified. Everything's re-verified. Then we go on to closing, set up that closing, send a mobile notary to your home. You sign the closing documents, and we fund it. Now, the thing to be aware of here, every single one of those steps I just did, which I overviewed very, very broadly, are all done on my team. It's not a different department. Everybody is a part of my team. I built this like going to Chipotle to get a burrito. Okay. Right? You don't just ask one person, I want a burrito, and they go in and they have a whole bunch, one person build it. It is a different person at different stages, all the way to that stingy ass person with the guac, right? And then you get to the cash register, which is funding, get it funded, and we move on. I do my best to control the entire process. The only variable is you. Because of your every client's different, right? And like you said up front, we're the probably better recyclers than we are lenders, because we recycle as much data as we possibly can to make it easy for us and easy for you.
Right. So the first one might be, you asking for quite a bit, and as you do your second deal and your third deal, it just starts to flow. You start to understand the system, gets a little bit easier.
Well, the person as complicated as you are, that first one, I guarantee, right as you get started, you're going to want to climb in bed with your shotgun and sleep with the muzzle in your mouth. It's that frustrating. Okay. But by the time we get through the first one, again, like you said, easier and easier. And you're just building on something that already exists.
But Aaron, what I've always loved and why I've done business with you is you're honest. Like, you're not like, oh, it's so easy, here's my name. I love that you're honest, and you're going to say, hey, listen, let's go get through this together. But if I'm going to fight a fight and go into something difficult, I want someone like you on my side, right? I don't want to fight my mortgage broker. I want to be friends with him. I want him to help me. And I always love how you'll get on the phone and, Dave, listen. And sometimes you'll talk me down the wall that they want a letter on, why this hit my bank account. And I'm like, are you serious? Yep.
But believe me, and I hate to, guys, everything you hate to give me, I hate to read. Yeah. Every call you hate to take from me, I hate to give.
No, but I actually love that you're on my side, even though we're tackling something tough. Because, we were talking about stated income loans. Remember how those were just 2006, 2005, buy 2, buy 3 homes here. Yeah, I make this much. No one, they spoiled us. They spoiled us back in those days, and now
especially those of us that used it and used it properly.
Yeah,
that's the other thing. Stated income loan was designed for a person that was making the money, but was going to have a hell of a time documenting it. Right. So a person who didn't make the money but just wanted to go after it anyway, those are the ones that caused the problem.
Yeah, absolutely. Okay, so front to end, the process with you, 30, 45, 60 day, what can we plan on?
Yes, 30 day is very, very probable. We had one just actually went from introduction to the processor to funding in 10.
Okay.
Right, because if you do it right, we can get it done.
if I'm a new investor, maybe have a couple homes in my contract negotiating, would you recommend 45 days?
I would
60
recommend
days
45 days on the contract
45 day
negotiation,
closing?
but put up 45 days or less.
Okay.
Because that way we can get it done
Okay.
quicker. Because some people, it's amazing how some sellers will
Right.
just become real pains and just say, nope, we're holding it to that final day. Well, if we can
Okay.
get it done in 20, let's get it done in 20.
So April 2024 rates 7, high sixes, low 7s.
If you're an owner-occupied buyer, you'll see 6.9% to 7.1% with 0 points. If you're buying an investment property, you can see 7.625 is our most common rate today.
Okay.
And there could be points associated with it.
Okay.
Now, if we want to get to a 0-point environment, we actually saw 10% in the last year.
Okay.
It actually reached that high last October, but they would never actually offer that rate. They're always charge 2 to 3 points to keep you under that rate.
Okay.
So we rarely see an environment where we don't have points these days for a real estate investor. And why is that? The prevailing attitude that the rates are going to come down is permeated everywhere. Even the people that should know that they're not going to come down.
Right.
The reason that they put that rate's a little bit lower, because we should be about 8.5 to 8.75% interest rate today with 0 points for an investor,
Okay.
but they're offering 7.6 with a couple of points. Because if it comes down from 8.5 where it should be to 7.6, everybody will just refinance, right?
Right.
But if they refinance within 3 years of ownership of that note, whoever lent the money lost money. So now they tie you to the lower rate with points so they don't get subject to that potential loss down the path. Because with the rates perceived to come down, everybody's afraid of a massive loss in Wall Street.
So just a strategy right now for your industry.
Yes.
Okay, down payments, which is always a big one for us investors. What are they looking at nowadays? If it's
20 to 25%, period.
Okay,
You can get away with 15%, but then you have mortgage insurance and you really have to make that deal pencil.
Okay, so
Some deals work that way.
So you can do 15% with PMI.
Yep. You
Pay
can.
a little bit more money if
It is
you
possible.
want to do that. Okay. Awesome. Well, Aaron, thank you so much. You've just given us a wealth of knowledge, and I just love having you really on my team in my investment world, and love that you can help people outside of Arizona and 30 states. So give us your company name, your website one more time.
So Aaron Chapman, I'm with SecurityNational Mortgage Company, and my website is aaronchapman.com. Just Google Aaron Chapman. There's only one bearded redneck lender on there.
Okay, and you often are running around this country doing presentations and conferences if people want to contact you for that, as maybe in a real estate investment association or something like that.
Yes, I
They can
speak
hit
on
you up there.
stages all over the place. I am constantly on podcasts. I've been on almost 200 podcasts.
Okay.
So yeah, you can reach out to me to book something like that. And if you want to get deep into the paint on why a person should be investing right now with higher rates and what their actual return is, not the cash on cash, not the cap rates, the actual return on investments, I'd love to get in that math with you.
Awesome.
And
Aaron,
how inflation benefits you.
Aaron needs to be on your team, guys. We're in an environment where we hear so many people with so many opinions, but hopefully after this podcast, you can see he's a straight shooter. He tells you like it is. He's not going to sugarcoat what doesn't need to be sugarcoated, and he's going to help you any way he can to get you funded on your next investment property. And until next time, continue to rent. Perfect.
Thanks, guys.